Hey everyone, it's Mark here from SnowOnly with a bit of an update for you. Firstly, we're getting so many lovely comments from people about these hoodies with the SnowOnly logo. Soon they are going to be available for people to buy. We always get really nice comments about that. So we decided to do a little bit of range. So look out for that. I just want to refer to an article that we had written a couple of months ago that seems to be becoming more of a topic of conversation amongst our buyers. And it kind of follows on from the 4-step guides that we had introduced earlier. If you've been following that, I'll put some links in. I'll put some links below this video for you to see the 4-step guides. But one of the other things that we've kind of been talking about is life insurance. And I always think there's a bit of a negative connotation with life insurance or any sort of insurance, because I guess it's risk versus reward. But the reason that we're kind of speaking about it, that it has huge implications in buying overseas property. And as we are generally in a position where it is overseas property, the ski property, whether you're wherever you're from, really, most people are buying overseas. So just wanted to kind of highlight this because I think it's a very relevant subject at the moment. So let me just bring this up and I will, nope. That's a bit better. So I just want to kind of read this article through for anyone that is considering. It's essentially for people that have basically made an overseas purchase. So it doesn't always apply to people that are thinking of making an overseas purchase. This applies to anyone that has a ski property already. Actually, any overseas property already. But as we are in the ski industry, let's keep it relevant. So any ski property. And you just could be at a little bit of risk here. So the thing that we're trying to do at SnowOnly is obviously the dream part is from looking and then buying your ski property. But there's all things that kind of run in the background, whether it be currency, mortgage, obviously no tears, and life insurance being one of them that either saves you money in the purchase process or protects your money in the purchase process, or in this case, as an owner. So let me just refer this to you and then you can have a look at it. So it's keeping Alpine property in the family with strategic life insurance that we wrote on April the 18th. So let me read this through. When thinking about how to protect your family, preserve your assets, or avoid a forced sale of things that you've worked hard to build, whether it's a ski chalet in the Alps or any other valuable holdings, life insurance might not be one of the first tools that come to mind, but it should be. Whether covering known inheritance tax liabilities, securing family stability, or ensuring business continuity, the right insurance strategy could make all the difference. While we'll explore specific applications for ski property owners throughout this article, the principles apply equally to diverse wealth portfolios. Life insurance serves as a cornerstone of comprehensive wealth planning, providing liquidity, protection, and strategic advantages, regardless of which specific asset you hold. So, as I said, not specific to ski properties, but if you do have an overseas property, this is definitely worth listening to. So, whole of life versus term insurance. Whole of life insurance pays out a lump sum when you die. A very morbid start, but obviously when you're skiing, we are in a little bit of a risk situation where the adrenaline sports, sometimes things happen in the mountain that aren't in your control. So we're just trying to protect your assets in this instance. So whole of life insurance pays out a lump sum when you die. As long as you keep paying the premiums, because the payout is guaranteed, it's typically used for permanent needs such as inheritance tax or assets that are unlikely to leave your estate, like the cherished ski chalet in the Alps. Did you know UK inheritance tax is charged at 40% on estates above the threshold? 325,000 plus 175,000 for a main residence if applicable. This quickly captures many families for whom this can mean a 7-figure bill. If you own a London house, a boat in the Mediterranean, and a ski chalet in the Alps, the combined value of those assets alone mean your estate is likely to face a significant tax bill. A whole of life policy, especially one placed in trust, provides a pool of liquidity to pay those taxes without forcing your family to sell cherished or illiquid assets. Whether that's the mountain property you've lovingly chosen, obviously that you've had all those memories at, and maintained the family home in London or other meaningful holdings. Term insurance, in contrast, covers you for a fixed period, e.g. 10 or 20 years, and only pays out if you die during that term. It's far more affordable and ideal for temporary liabilities such as outstanding mortgages on your ski property, replacing income for dependents, covering schools for university fees, or providing short-term inheritance tax cover if your estate is reducing over time. So paint the picture. Consider this as a scenario. Your estate is worth 5 million now, including a ski chalet you're planning to gift, but you're planning to reduce your estate to 3 million through gifting and tax planning over the next 10 years. A term policy can cover the tax on the 2 million gap for a decade at a fraction of the cost of whole life. What's the price of certainty? Unsurprisingly, whole life insurance costs more because the payout is guaranteed. A healthy 50-year-old non-smoker may pay $7,000 a year for 1 million of whole life cover, which could be significant to protect a ski property valued at 2.5 million from inheritance tax. The same cover for 20 years via a term policy might cost around $1,200 a year, a substantial difference that reflects a reduced risk to the insurer. Costs vary with age, health, and underwriting, but the key difference in this is term is cheaper, but temporary. For ski property owners planned in multi-generational ownership of Alpine retreats, the certainty of whole of life might justify the additional expense. Gift inter vivos policies. Gifting wealth during your lifetime is a common estate planning strategy for ski property owners. In the UK, gifts fall out of your estate after 7 years, but if you die within that window, the inheritance tax may still apply, especially in the first 3 years. From the 3 onward, taper relief gradually reduces the tax liability each year until it drops to 0 after 7. A gift inter vivos policy is a specific type of term insurance designed to cover this risk. The cover decreases over 7 years, mirroring the tapering liability. For example, you gift a 1 million ski chalet to your children. If you pass away within 7 years, inheritance tax may still apply, with a full 40% rate potentially due in the first 3 years. A gift inter vivos policy ensures that this liability is covered without burdening your family or disrupting the enjoyment of their mountain property. Business protection, cross-option agreements. Many ski properties, particularly those of high value, are held within company structures or tax efficiency or shared ownership. If you own a property through a business partner or co-shareholders, life insurance can protect both the business and your family from unintended consequences. A cross-option agreement supported by term insurance ensures that if one partner dies, the other can buy the shares at an agreed price. This keeps ownership of the property in the hands of people who understand the business and avoids leaving your family with illiquid, hard-to-value shares that may not want or know how to manage. These arrangements are typically set up with term policies running to retirement age and should reflect each person's shareholding. For ski chalets held in corporate structures, this approach can be particularly valuable as managing foreign property through a company requires specific expertise your family members may not possess. The tailoring to needs, there is whole life insurance, term insurance, and decreasing term insurance here. Obviously, we'll put the link below for you to kind of read through it all. And then we have structuring is key below. And then final thoughts. I think this is interesting. Life insurance just isn't about protecting against the unexpected. It's a powerful, flexible tool for wealthy families looking to preserve wealth, manage risk, and protect the next generation. Whether your portfolio includes ski properties, multiple homes, business interests, or investment holdings, the key insight is that life insurance serves as a strategic planning tool rather than merely a safety net. For ski property owners, it ensures your mountain retreat remains in the family. For business owners, it provides continuity. For investors, it delivers liquidity when needed, when most needed. If you're not sure whether your current plans fully protect your family or business from tax or liquidity pressures, a thorough review might be worth millions. These policies are rarely in front of mind, but when structured well, they sit quietly in the background until they are needed most, much like the peace of mind that comes from knowing your wealth is secure and your legacy protected. What we will do here is, let me just get back to the video. Based on that article, what we'll do here is we work with a company that obviously specialises in this. We are our specialist is the ski property, but as I said, there are things that run concurrent in the background, whether it's mortgages, notaires, currency, and life insurance. It's a really interesting thought that anyone that is buying an overseas property, as we said, let's stick with a ski property, and they've, let's say, invested 5 million in their ski property. If something does happen and there is a 40% tax liability on their property, which is 2 million, you don't want that pressure then to be passed on to your family that needs to pay it straight away. And then obviously have to maybe sell the property cheaper, etc., etc. So by taking out a insurance policy of that, then it protects that liability of 40% that then could be paid straight away for the inheritance tax. So then you can hold on to your asset. So these things are fundamentally important. I do think it's interesting that people spend so much money, obviously, on properties, whether it's a little or a lot of money, and don't have these in place in the background. So what we will do, send us an email to info@snowonly.com if this is of interest to you. We will pass you on to our partners who are specialists in this, and you can have a little chat with them for free. And then you can find out if this applies to you or set something up with them. But I do think it is fundamentally important that not only are we selling the ski property, but we are also protecting the asset that we are trying to sell to you as well. So I hope that all makes sense. If you have any questions, please feel free to send them in. And don't forget to look out for the hoodies when they come round. Take care. Bye.